Welcome back to Risk to Reward. Lloyds Banking Group shares have moved strongly over the past month, continuing a recovery that has been building across the UK banking sector. Looking at the price action from last month to today, Lloyds shares are up roughly in the range of 10 to 12%, recently trading around 112 to 113 pence. The move higher has been relatively steady rather than driven by sharp spikes, with higher lows forming over the month and reduced volatility compared with earlier periods. This suggests the market has been gradually repricing Lloyds as confidence has improved around earnings resilience, capital strength, and shareholder returns. The rally has not been the result of a single announcement, but a broader shift in sentiment toward UK banks as investors reassess risk versus reward. For transparency, and mentioned simply in passing, I currently hold 10,715 Lloyds shares. This is disclosed purely for clarity and does not alter the analysis. Turning to why Lloyds has performed well, there are several clear and up-to-date drivers behind the share price strength. First, Lloyds' most recent full-year results showed improved profitability, with pre-tax profit reported at approximately £6.7 billion, representing a year-on-year increase and coming in ahead of market expectations. Income remained resilient despite a more competitive lending environment, while cost discipline supported margins. Second, Lloyds continues to benefit from its dominant UK retail and commercial banking franchise, which provides a large, stable deposit base and predictable recurring income. Third, capital strength remains a key support. Lloyds has maintained a strong CET1 capital ratio. This has translated into meaningful shareholder returns through dividends and buybacks, reinforcing investor confidence. Fourth, ongoing digital and operational improvements have supported efficiency, helping Lloyds manage costs and improve customer engagement across its core banking platforms. Fifth, Lloyds has continued to diversify beyond traditional banking through Lloyds Living, its build-to-rent platform. The portfolio is currently valued at around £2 billion and comprises roughly 7,500 homes. Management has stated an ambition to grow this platform toward approximately 50,000 homes by 2030, which is intended to generate long-term, stable rental income and reduce reliance on purely interest-driven earnings over time. Finally, looking at dividends, Lloyds' payout profile has changed significantly since the COVID period. During the pandemic, dividends were heavily restricted following regulatory guidance, with only a small final dividend paid in 2020 and no interim payment. Since then, dividends have steadily recovered as profitability and capital levels improved. Total dividends increased through 2021, 2022, 2023, and 2024, reflecting a normalization of payouts as restrictions were lifted. The most recent full-year dividend was declared at around 3.5 pence per share, supporting a dividend yield in the low to mid-single-digit range depending on the share price. For the current year, the next ex-dividend date is scheduled for early April, with payment expected in May, in line with Lloyds' established dividend timetable. Together, the recent price movement, improving earnings, strategic diversification, and dividend recovery explain why Lloyds shares have been re-rated by the market over recent months.